How can two investors earn the same rate of return in retirement but have completely different outcomes? In today's video, we're going to talk about one of the most important factors in your retirement success as it relates to the timing of your investment returns. We're going to look at a few charts, and we're going to talk about why when you get the returns you get is just as important, if not more important, than your actual returns. Okay, let's get started. So I want to go through a couple of different scenarios. And the first scenario is if you just earned a 5% rate of return in retirement, what does that look like? What if you earned that same 5% rate of retirement, but you had good years in the beginning and you had bad years at the end? And then we're going to look at another scenario where that's flip-flopped. So you had bad years in the beginning and good years at the end. And then lastly, we're going to say, what if you just got 5% across the board, right, every single year, and there was no ups and downs in your returns? So let's look at this chart here. What this shows us is the gray bar is if you were just going to get a 5% rate of return every single year, no money going in, no money going out, you would start with $100,000. 30 years later, you'd have about $432,000. Okay, so that's a 5% rate of return each and every single year. Well, what if you have a great start? Well, that's this purple line. It starts to go up. You have great years in the beginning, and then it goes down towards the end, and you end up with that same $432,000. Now, what if it's the opposite and we have the bad start? It starts down low. You have a bad couple of years in the beginning, and then later it starts to go up at the end. As you can see, the ending portfolio balance is the same. Whether you get a 5% average rate of return every single year and it's always the same rate of return, whether you start well or whether you have bad years in the beginning. So it doesn't really matter when you get your returns if there's no money going in and out of the portfolio. Now, let's talk about what happens when there is money going in and out of the portfolio, because that's where your portfolio dollars get impacted. So first, let's not start with a retirement scenario. Let's talk about a savings scenario. And if we start with that 5% rate of return, you start with zero, you're putting in $10,000 a year, you end up at 30 years with $664,000. That's 5% each and every year with a 5% average. Well, what happens if you have a great start? In the beginning years, you have the markets going up, and then towards the end it goes down. Well, if you start great and end bad, you end up with $485,000. You end up with less money than a 5% rate of return consistently. So even though you return the same 5%, you started great, ended badly, you have less money. And let's talk about the opposite. What if you have a bad start and a good ending? Well, you actually end up, even though you just have a 5% rate of return, you end up with $948,000. So why is that? Well, when you're saving early on, there's no money in your account. If you're saving $10,000 a year for 30 years, that's great. Congratulations on your saving. But bad years early on don't have much of an impact because there's not much portfolio value to go down. And so when you have good years later on, when you have more money, that's more helpful. So bad years early, great years late, that's more helpful when you're talking about saving in a portfolio. And so in this scenario, even though you're earning a 5% average rate of return in all three scenarios, when you're saving, you end up with much more money when you start with bad years and you end with good years, because later on down the road, after you've accumulated a lot of dollars, those good years have more impact because there's more money to go up in value. Okay, now let's look at the opposite scenario, and that's what the primary purpose of this video is what happens when you start bad and end good versus start good and end bad when you're taking money out of the portfolio. When you are retired, how does this timing of returns impact us? Well, it's exactly the opposite of when you're saving. So let's look at this chart here. This assumes we have $1 million, we're taking out $40,000 a year, it's going up a bit for inflation. If you earn a 5% consistent rate of return, and you're taking out that $40,000 a year, after 30 years, your $1 million ends up being about $585,000, okay? Well, what happens if you have a good start and a bad ending? So the first few years of retirement are good, 30 years down the road, you have a couple of bad years, but you're still averaging that same 5% rate of return. You start with $1 million, and you end up with $1.59 million. assuming the same distribution rate and the same average rate of return of that 5%. So you end up with much more money with a great start and not doing great later on. Well, what happens if it's the opposite? What happens if in the beginning of the retirement years, you have a bad year and you still average 5% rate of return, but you have the bad start right at the beginning of retirement? Well, as you can see, this blue line doesn't even make it the full 30 years. You run out of money after 22 years and you end up with $0. So every single one of these lines, all three of these lines, have a 5% average rate of return. But what happens is when you move into retirement and have bad years in the early years, it can be detrimental to the success even though you can get the same rate of return as somebody else. So when you get those returns is just as important as the actual returns you get. Now, what's the point here? Because you can't control the returns you get in the stock market, of course. We don't control when the market goes up and when it goes down. What this means is if you are in the position where you are taking funds out of your portfolio, in particular in the early years, you want to make sure that you know from a portfolio standpoint every position you own, and like I always say, know what you own and know why you own it, and make sure that you are being compensated for any risk that you're taking in the portfolio, because early on, excess risk and having big downturns while you're taking money out can have a big impact. I hope you found this helpful, and as always, thanks for investing your time at The Personal CFO.